Imagine a bustling marketplace. Stalls overflow with colorful goods. Vendors hawk their wares with booming voices. The air thrums with a chaotic energy. This is the dance of demand and supply in action. Buyers and sellers engage in a constant negotiation. Buyers seek the best products at the lowest prices. Sellers aim to maximize profits by offering goods that people want. This interplay creates a dynamic balance, a constantly shifting equilibrium. This marketplace scene, as chaotic as it may seem, is a microcosm of the global economy. Understanding the forces at play here, the forces of demand and supply, is essential for anyone who wants to navigate the world of business. Demand is more than just wanting something. It's the willingness and ability to pay for it. The law of demand states that as the price of a good or service goes down, the quantity demanded goes up. Let's take the example of a new smartphone. When a new model launches at a high price, only the most eager early adopters will buy it. But when the price drops, perhaps during a promotion, demand surges. Suddenly, more people are willing and able to purchase the phone. This inverse relationship between price and quantity demanded is a fundamental principle of economics. It helps explain why businesses offer discounts and sales. They are trying to stimulate demand by making their products more affordable. On the other side of the marketplace, we have supply. This refers to the quantity of a good or service that producers are willing and able to offer for sale at various prices. It's a fundamental concept in economics that helps us understand how markets function. The law of supply states that as the price of a good or service goes up, the quantity supplied also goes up. This is because higher prices provide an incentive for producers to increase production. Think about beverage production during a hot summer. When the weather heats up, people crave cold, refreshing drinks. As the temperature rises, the demand for refreshing drinks increases. Stores see more customers buying these beverages to cool down. In response, beverage companies ramp up production to meet this demand. They increase their output to ensure that there are enough drinks available for everyone. They are willing to supply more drinks because the higher price fetches them greater profits. This motivates them to produce more and meet the rising demand. This direct relationship between price and quantity supplied is another cornerstone of market dynamics. It shows how supply adjusts to changes in price. It highlights the incentive for producers to offer more of a product when they can sell it at a higher price. This dynamic ensures that markets remain balanced and responsive to consumer needs. Harmony in the market, the equilibrium price. The interaction of demand and supply determines the market price of a good or service. This dynamic relationship is fundamental to how markets operate and ensures that resources are allocated efficiently. This occurs at the point where the quantity demanded by buyers equals the quantity supplied by sellers, the equilibrium price. Imagine a local bakery, bustling with activity. If the bakery sets the price of its bread too high, demand will be low, and they will be left with unsold loaves. These unsold loaves represent wasted resources and lost potential revenue for the bakery. Conversely, if they set the price too low, demand will outstrip supply, and they will run out of bread quickly. This situation can lead to customer dissatisfaction and missed sales opportunities. The bakery's goal is to find the sweet spot, the equilibrium price, where they sell all their bread without any excess demand or supply. This balance ensures that customers are happy and the bakery maximizes its profits. This point represents the harmonious balance between buyers and sellers in the marketplace. Achieving this equilibrium is crucial for the smooth functioning of any market, ensuring that both parties are satisfied and resources are used efficiently. Shifting tunes, factors influencing demand and supply. Demand and supply are not static forces. They are constantly in flux, influenced by a myriad of factors. Changes in consumer preferences, income levels, technology, and even news events can shift the demand curve. Similarly, factors like production costs, natural disasters, and government regulations can impact the supply curve. For instance, news of a health benefit associated with a particular fruit can cause a surge in demand, shifting the demand curve to the right. Conversely, a natural disaster that disrupts the supply chain of a product can lead to a decrease in supply, shifting the supply curve to the left. Understanding these shifts is crucial for businesses to anticipate market changes and adjust their strategies accordingly. Real-world rhythms, applying the concepts. The principles of demand and supply are not just abstract economic theories. They have real-world applications in various industries. Businesses use these concepts to make informed decisions about pricing, production, marketing, and resource allocation. For example, ride-sharing companies use dynamic pricing models based on real-time demand and supply fluctuations. During peak hours or special events when demand is high, surge pricing kicks in, encouraging more drivers to come online and balance the market. Understanding these dynamics can help businesses optimize their operations and maximize profitability. Mastering the dance: a roadmap for future business leaders. For students aspiring to be future business leaders, mastering the dance of demand and supply is paramount. This dance is not just about understanding numbers, but about interpreting the story they tell. These concepts form the bedrock of economic decision-making and are essential for navigating the complexities of the business world. They are the foundation upon which successful strategies are built. By understanding how demand and supply interact, you can analyze market trends and anticipate changes in consumer behavior. This insight allows you to stay ahead of the curve and adapt to market shifts. Develop effective pricing strategies that balance profitability and customer satisfaction. Pricing is an art and a science, requiring a deep understanding of market dynamics and consumer psychology. Optimize production and inventory management to meet fluctuating demand. Efficient operations ensure that resources are used wisely and that customer needs are met promptly. Make informed investment decisions based on market analysis. Investing wisely requires a keen eye for detail and an ability to foresee future trends. In a world driven by constant change and uncertainty, a firm grasp of demand and supply provides a competitive edge, enabling future business leaders to make informed decisions and thrive in the dynamic global marketplace. This knowledge is not just a tool, but a vital asset in the journey towards business excellence. Start your journey today. Embrace the dance of demand and supply, and lead the future of business with confidence. Subscribe to our channel for more insights and resources to help you succeed.